Good morning. Welcome to EQIX Insights. Today is June 26th, Friday. We're before the market open. We've just had a really volatile week. We've seen a lot of big moves on both sides of the market and across different sectors. And the semis still continuing really strongly, but at the same time, hyperscalers, software companies, and crypto are down massively on the week as well. So we're seeing a big dichotomy in the market where the pick and shovels play are firmly intact, but investors are quite worried about the profitability of the big AI investments, and at the same time, the validity of the old business models like SaaS going forward. And I think there is some sort of tension here because if you're pricing a prolonged AI capex build out, which justifies the valuation of the likes of Micron and other semiconductor stocks, then there must be some validity to the hyperscalers capturing the profit down the line on the distribution side, because if it is really not a profitable play and hyperscalers just spending cash and burning it on fire, then in a year's time they might realize that and stop spending as much and retreat their AI play, which will then lead to the end of the cycle for the memory stocks, etc. So I think it is worthwhile watching the tension between the optimism on one side and pessimism on the other, and we're really looking for the opportunities on both sides of the market going forward. So before we start our analysis today, I'm excited to introduce the Multimodel Signals, which is a huge upgrade to our machine learning signals that we're currently doing. And I'm going to deploy this new approach from next Monday. So a quick overview. So in our existing machine learning signal work, we only use one model. And in a machine learning model, we use a combination of cross-asset prices as well as the asset's own price technicals as inputs. And we use a machine learning model to drive individual daily assessment of the asset, whether it's risk on, risk off, whether we should be long or stay flat. So I have now introduced three new models. So the first one is a neural network model. So this is quite a different type of model to the machine learning model. It's a little bit more black box, but would give us a valuable lens to its assessment on the state of the market. And I've also introduced the trend model. It helps us stay on the right side of the trend. So this trend model is applied differently to different assets, but the idea is basically we're trying to spot the trend and we're trying to stay with that trend, whether it's on the bullish side or stay out on the sidelines when it's on the bearish trend. When we try to stay on the right side of trend for as long as possible. And finally, we have the regime model. So the regime model basically assesses the market's hidden states into three buckets: risk on, risk off, or neutral. And it's a bit like telling you the season. And if it's the rainy season, you better dress with a raincoat, come out with an umbrella, take some risk off. And if it's the sunny season, and you can celebrate a bit more and be a bit more exploratory. And the way those four models work with each other, I've backtested each individual model against every asset, as well as the combination of the models. So it could be a combination of 2 or 3 or 4 to each asset. And on the data, the models haven't seen, so it's not overfitting. And we are trying to pick up the combination of models, or even in some cases, it's just a single model that works best for that asset. So every day you're going to get this output. So using the stock indices and bonds and dollar as an example, we still have one definitive position, whether it's long or flat. In certain cases, where we can apply leverage, but I have removed the shorting strategy completely. And the way to interpret this is that we have 4 models. So M stands for the machine learning model, N for the neural network model, trend, T is the trend model, R is the regime model. And you can see whether the model agrees with this position. So if the position is long, then we're looking at the green color here. That means the M and the T and R models all agree with the long position, but the neural network model dissents it. So it doesn't agree with it. But still, the outcome is that we are in a long position and we're maintaining long. So this is the 3-month history. You can see that we're flat up until probably 2 months ago, and we're going long since 2 months ago. And in the case of Russell 2000 RWM, all models agree with this long position, and the volatility of RWM is not overly volatile, so we are comfortable with applying a 2x leverage to this position. On the other side, we have the semiconductor SOXX, and we're going for a flat position. So the flat doesn't mean you want to short it. It just means we're not interested in buying this model, buying this asset or holding this asset at this moment. And the 3 models, M and R, agree with this decision. So in gray here is showing that it's agreeing, but there's a hollow marker here for T. So that's a trend model which disagrees with this decision because SOXX has been trending up pretty nicely, still above its key moving averages. So the T model is disagreeing, but overall, our conclusion is that we should stay flat or stay out. And this is a quite recent change as well. So we've been long for a while, and recently we're staying out. For SPY, we are staying long. All 4 models agree, but the reason we are not leveraging in this case is because SPY's volatility has gone up, and therefore, in our back test, we find that if the volatility is too high, you're prone to big drawdowns when the asset goes the other way. And that's not ideal either. So we are staying long, but we are not going to double our risk. And in the case of TLT bonds, the decision is flat. The 2 models that agree with this decision is neural network and the regime model. And that's sufficient for reaching this decision, given our back test. Where our assessment is that given this output, we're okay with flat. So it's not always a majority win that drives the decision. It really depends on the individual asset and how our models have performed in combination in our back test. And you're still going to get this daily commentary given our model outputs. So you can still see the top features that drive the model outputs for each day. So we include our Chinese equities for assessing the S&P 500, for example, as an input. We're also looking at the trend, and we're also looking at the market regime, which is still constructive, and therefore we're long with conviction. So now moving on to the position history. So every day I will show the 3-month history, and it's very simple. So green is long, dark green is 2x leverage, and gray is basically staying out. And what I really want to emphasize now versus what I used to do is that because we have such a wide coverage, really we should be focusing on the ones that are long and rotating money out of the ones that are flat into the ones that are green. I'm not really treating the flat signal as a negative signal. I'm going to short it. Shorting has proven to be too difficult, both in our live setting and in our back test. So and I'm not going to try to fight this signal as well because I have a long position or something. It's just a risk warning that, okay, the model is not as convinced as it used to be that we should stay long here. And here are some other assets that could offer better risk at this point. So this is using a 1-year forward walk forward back test. What all that means is that we're applying the model from 1 year at the beginning of the 1 year ago, as if we're doing it live, and how would the models compare with just buying and holding, and we're using this across the entire fleet of tickets we cover. So in this new approach, we will cover some more names as well. So here isn't really the absolute numbers. The point is comparing is against a buy and hold. You can see the baseline strategy would give you about 40% return with a maximum drawdown of -9%. Whereas for buy and hold, it's only 26% return, which is still pretty good on a 1-year basis, but versus a maximum drawdown of 16%. So we're getting better risk versus also better drawdown as well. And if you lever at the right time when the model's in agreement on the long side and volatility is low, we can amplify our gains without reducing, without making our max drawdown much worse. So I think there is always a little bit trade-off, because when you're amplifying the gains, you will come with a deeper drawdown, but it is an acceptable cost to me for a slightly worse drawdown but much better gains. And finally, I want to put a conclusion to our previous machine learning signal. So that is just using one model going live since April to June. So we've onboarded different tickers, different asset classes at different various points in 2025. But the comparison is a fair one. So it's apple to apple. So we're just taking equal position comparison for when the asset came live versus the buy and hold. What we see is that our machine learning model as a whole across different assets have returned 20% with a 14% drawdown, which is a Sharpe of 0.9, so shy of 1. But buy and hold gives you around 17% with a 60% drawdown and a Sharpe of 0.6. So our Sharpe is significantly better. And this includes the equity indices, Max Evans, bonds, precious metals, commodities, as well as crypto. What I tend to see is that in a strong uptrend, so for example, if you have a semiconductor name, the machine learning model could step aside a bit prematurely. So it kind of runs and performs the underlying asset in the uptrend. But when the cycle completes on the downtrend, because the machine learning model steps aside early enough, it outperforms on the downside by staying away from the falling asset. All of these results will be shared on my website as a record. And then from next week onwards, we can start looking forward to the multi-model approach and the live record starting from then. So now moving on to our market analysis. I posted this chart last week. So we're comparing today versus 2000, so the dot-com bubble, and to assess whether we're near the top. And I think the pattern is pretty strikingly similar. So we had a bit of a wobble. So if you remember this dip here, so that was the Liberation Day. So March to April 2025, we had a recovery, and we had the Iran war, which is a big dip here. We also had similar things in 1998, 1999. And today we're seeing another wobble, which could coincide with the beginning of the dot-com bust. But still, if we're following this sort of trajectory, we're still going to see one more high. And interestingly, Tom Lee has upgraded his year-end target to 800 based on robust earnings growth. And we can see here that if actually we follow this trajectory of the dot-com bubble, we could actually reach above 800 within a year. So that kind of all lines up beautifully. But still, if we do follow this map, it suggests that we probably top around later this year, but we'll have a double top in early 2027 before a massive sell-off. And that coincides with a potential hiking cycle in the Fed, who are now really worried about inflation, and they pledge to deliver price stability. So looking at SPY in terms of the near term, it does appear like a very clean ABC setup here. So we've had ABC in wave A, then we had a corrective bounce in wave B. This is something I've been warning for a couple of weeks. So before it was formed, I was concerned that we could have a corrective bounce, and now it's been confirmed. what you see is that we've had 7 days of red candle. What a red candle means is that the market opens high and it sells off, it closes below the open. So we are going for 7 days of red candle, and we're now in the pre-market trading below the 50-day moving average. I think if we're targeting the wave C, we could trade all the way down to 710 to complete this wave C, which is the 100 to 123% extension of this wave A. So I know a lot of people don't really believe in early waves and technical analysis and stuff, but all we're doing is really just measuring the size of directional moves versus the prior moves to derive the state of the market. Is a technique to understand the state of the market, whether it's in a bullish trend or is sort of a consolidation or bearish. It doesn't, and it's quite clear here that we are consolidating here, and we are still in a strong uptrend. That's undeniable. We're still holding around the key average of the 50-day, and we're above the 100-day moving average, the 200-day moving average. But here we're definitely in a consolidation mode too, and that could point towards a lower low than June. And similarly for QQQ, I'm not saying the top is in, but in the near term, we could be seeing a lower low in wave C that points towards 670 to 685 at the 100% extension of this wave A. So that would mark basically a 3-month consolidation period between May and July, which give us a nice base to run up towards the midterms. IWM, so IWM is a different story because even though it is a bit more, it has its up days and down days, overall it's trending up much more nicely than SPY and QQQ. And I would say that's because it's been less stretched. So on the rise, it's been behind the move versus QQQ, which has been driven by big tech and semiconductors. And more recently, we're seeing bond yields falling in the long end, which kind of provide a relief, a bit of a tailwind for the small caps. Semiconductors, we're seeing it's still staying within this nice price channel on the uptrend. So unless we see a dip below this, it's really hard to call the tops. But what you can see is that when you have a candles like this, which is the doji candle, where the body is extremely thin, so it opens above the previous day, or you could be in line with the previous day, but it doesn't find enough bullish momentum to close above the open. We get a doji candle. It means the bullish and the bearish momentum are canceling each other out. In the uptrend, that usually is a near-term bearish signal, because if the bullish if the bulls have been in control, why can they not push it higher? So what you tend to see is a near-term market reversal following this candle, but it doesn't mean the absolute top. So it's just something that's an interesting pattern for semiconductors. That is a bit of a warning signal, I would say, but still we're staying within this trend. If we break below this, then we can maybe see the 50-day moving average quite quickly. And if, of course, it below the 50-day, then we are really thinking about, okay, maybe this market could have topped. We're looking for a bigger wave 4 dip on the larger degree. For IGV, so what IGV is seeing is that we've had a nice run up, but my real concern is that this run up has been in 3 waves, and we've declined off this top as at the beginning of June, and unfortunately that looks like a wave B corrective bounce instead of an impulsive move, especially now this retrace has dipped below all of the key moving averages, as well as approaching this wave B low. So what I'm concerned about is that we could see one more low in this wave C from a technical point of view. And as you will see later in the Microsoft chart, Microsoft had already broken a new low, so it could be preceding the wider retreat in IGV. Looking at oil, we haven't really talked that much about macro today, but So oil has seen a very clean, impulsive downward move. First, it had a head and shoulders. It broke below this neckline here, and this move here has reached our target of 105, which is the 1.38 extension of this wave one. So this is the typical target. Of course, it can extend all the way below to 100 to fill it more deeply. But what I would say is that if I was short, I would probably cover my position around here. And there's a chance we get a wave four rebound next that probably reaches the 100-day moving average, and then one more low in wave five. And all of that would mark the beginning of the downtrend. So all of that would be a large degree wave A. And then looking at the 2-year bonds, so if you can see, the 2-year yield has been going up pretty strongly. So the market is actually pricing in at least one hike this year, with a decent chance of another hike this year as well. Basically, is pricing a pretty hawkish Fed. But the caveat is that now oil prices are coming down. There's a chance that inflation would tame in the next couple of readings, and that could give the Fed comfort to basically not hike, but just to keep on hold for a long period instead. But at the same time, we actually see the yield curve flattening. So flattening means that long end yields coming down while the long front end yields going up. So the 30-year yield has come down quite a bit from the 5.2% high. So that has been a bit supportive for small caps and high beta names in that sense. And if you look at TLT, so TLT is the invert of the yields, is now moving up towards the highs. So above 87 is broken above all the key moving averages. So the market doesn't think we're going to have a full-on hiking cycle where the Fed doesn't stop after 2 hikes, and to fight severe inflation. Is actually saying that if the Fed has to hike twice, that's probably enough anyway, and we can keep the yields at a similar place to before the war started. So looking at Bitcoin, so unfortunately, Bitcoin made new lows this week. So every time it makes a new low, it always opens the door to a much lower drop. So when I see a trend line being broken, I'm really cautious. That happened back in January. That's the first time, but then it happened again in May. That's the second time. And what we see here is that we're actually trading around the February low. And just remember how much panic there was at that time. So I think this could open door to a lower low towards the low 50s. Just technically speaking, if wave 5 reaches the 1.38 inverse extension of this wave 4, then we're looking at the region below 52K. We can even go down to 48K. And I think that could probably happen quite quickly as well within the next month. And if you look at the price of MicroStrategy, you can see that sort of capitulation happening in real time. So for MSTR, so we can see that this wave 5 is happening quite rapidly in the past week. I have been warning this, that we could see one more low versus February, which is now happening. But in terms of the extension, this wave 5 is about to enter a typical target zone around 64 to 80. And I know it sounds quite ridiculous how MSTR could trade at 65 or 70, but looking at the price now at 85, that also seems quite ridiculous compared to what we had back in November last year at a high of 500. For ETH, so ETH sell-off preceded Bitcoin in terms of levels. It already made a new low back in the beginning of the month. So here, again, I am quite cautious on how far this could drop. So looking at this move, if this is a 5-way move, then the extension of this final wave is now reaching the standard target at the 1.38 extension versus this wave 4 bounce. So in a way, I think the ETH probably front run Bitcoin in its drop. of course, is it's not as liquid, and there's potential downside to 1.4K, but that's not far away from where we're now. So it seems that ETH could travel lower, but the downside target is quite close in this cycle. Again, this will challenge the low of April 2025 as well. And we just want to be quite cautious on how it bottoms, whether it can hold above this low to find a bottom or not. Looking at Coinbase, so Coinbase actually has held its beginning of the year low quite well, but just looking at the overall shape, this is likely a 5-wave down, and we couldn't find a very strong wave B bounce. We didn't even attempt the 200-day moving average, and it's headed back again. So if we break this lower bound support, supporting trend line that started since August 2024, then there's a definitive risk for a much lower wave C that will be sub 100. So the best hope now is for this trend line to hold, but I'm not extremely confident about that right now. Robinhood has been a bit better in terms of its price technicals. After its layoff, it broke above this trend line, but it's now reversed after reaching the 200-day moving average. This wave C is still only at about 120% extension of this wave A. So this bounce is still a very likely B wave, which means there's still a chance that we get a lower low in wave C. So what we really want to see is that first, if now it's coming back, can we stay above this trend line? And if not, can we stay above this supporting trend line? And that used to be the high of the February 2025. If we break below this and break below this March 2026 low, then definitively we're looking at a much bigger drawdown in wave C. That probably unwinds all the effort Robinhood had made in the past couple of years. Looking at gold, so gold is in a bearish downtrend, and there isn't really a lot of support levels we can find here apart from this lower support zone here. So it's unclear where wave 5 will end. But one thing I would be a bit more certain is that after this 5-wave down, is unlikely to make a new all-time high straight away. The next set of bounce is likely a wave B bounce, and we could enter a quite prolonged consolidation cycle for gold. And one thing gold has to fight for, as for crypto, is if we get high interest rates or if we get a full-on hiking cycle and a stronger dollar, the relative value of gold is weaker. And that's more of a mechanical thing. So gold miners has been holding a bit better than gold itself, but again, below all key averages, still in a downtrend. So there isn't really reliable way of telling where the wave C could end. So this wave, so gold miners has a 3-wave downtrend because it made one more high in this wave 5. So we're starting from this high to look at the downtrend. We are looking at wave C being the 100 to 123% extension of this wave A, which gives us a target range over here. So it could really land anywhere in this zone between 66 and 74. It's already tapped the shallow end of this target. I will just be basically watching for consolidation. Silver had made a new low this week, broken below this trend line, which is pretty bearish. So just looking at the size of this final sell-off versus this bounce, we're basically at a sort of the middle of our sell-off target, which is typically between the 1.38 and the 1.76, the inverse extension of this rebound. So we could be looking for a rebound in wave B next swim, but it's really hard to tell how this will consolidate. It could travel a bit further down to 47 before it consolidates. So we just have to be quite patient about this. And I think it's quite difficult to see a new all-time high in the near term, and very unlikely in 2026 we could see a prolonged consolidation here. Again, silver miners, this wave 5 is still developing. We could see a dive towards below 70 to potentially 60 to complete all 5 waves. Again, this would be the broader degree wave A, followed by wave B bounce, and then wave C of this wave 4. Copper. So very unfortunately, I have been warning this ABC potential in my previous videos, and the bullish scenario would be that it's still going to move towards a wave 3 high around 43, staying within its channel. But this week it has broken below it very definitively, and we can probably remove this bullish scenario out. So that makes it quite difficult to assess where we are in the cycle. We could have had this wave 5 already completing prematurely for our standard, and this wave 3 also completing. That will line up with the precious metals, even though this is the industrial one. And then we are seeing a flat structure. So what that means is that we are seeing a broader consolidation in this wave A, B, and C. And if we just, what we can see is that this is maybe wave A in 3 waves, wave B in 3 waves, and we're looking for one more low in wave C in 3 waves. With an expanded flat, so because this wave B exceeded this high, the destination for wave C, it could reach around 30 or even sub 30 to complete this wave C. So I'm getting a bit cautious here. Palladium, so again, very definitive downtrend here. We don't need to get very excited until we see a breakout, but even then that could be a wave B bounce. Platinum, similarly, we're seeing a 5-wave move in a very well-defined downtrend, or pushing the bottom end of this price channel. So we may see some reversal, but again, that reversal could be a corrective wave B that finds resistance in this high volume region here. Uranium. So now I'm a bit more confident that this was wave 5 high. The reason being that this is a very likely head and shoulders pattern where the right shoulder fails to exceed the head. And we're seeing this as a rising neckline, which is now broken. So you can see that uranium broke below this neckline, trying to find a bounce, which is also the 200-day moving average, failed to break above, and now we're moving down. So I'm quite cautious about where we can go from here. I certainly wouldn't want to buy the dip too early at this moment. BCI, so BCI is following broadly the trend for oils. Oil has been dipping since mid-May. So I would say that to analyze this chart, we basically follow what you think oil would do, which we covered earlier. So Apple saw a sell-off because it raised the price, and it raised the prices of its products because of the expensiveness of memory chips and storage. So the market has a negative read on this because phone makers is a very competitive market. You can see the rise of many alternative handsets now. So we're pricing in a reduced profit margin or reduced volume of iPhones being sold in the near future, and the market is getting a bit pessimistic about that. What I can see is that if this is wave C, it has reached the 100% extension of this wave A. So this is still valid 3-wave move. It could extend to all the way down to the 200-day moving average at the 270, and that can still be a wave 4. What you'll notice is that this wave 4 overlaps with the wave 1 already. So it's right at the top of the wave 1, and it could come in a bit deeper. So this would make this wave 5 a an ending diagonal. So an ending diagonal is when wave 4 overlaps with wave 1. And so I would probably follow this price channel here where we can touch the lower end around 270 and then try to find a bounce for wave 5 going to September. So they're making new iPhone releases in September, and historically going from September to December, that is a bullish holiday sales period. If we have the foldable iPhone, that could excite the market. Then you can follow the lead time for those products to see if the demand is high. Amazon. So Amazon, I think the overall structure is not actually terribly clear, but we can see on the smaller degree is that we are seeing a 5-wave down in this wave A. That's now below the 200-day moving average. What I would expect is a wave B bounce next. And the wave B bounce is quite variable. It could stop at this 50-day moving average before a deeper wave C. I think once this pattern completes, we have a better idea of the overall structure. But right now, I'm staying cautious on Amazon. Google, again, a near-term downward channel after a relentless rise early in the year. And what we can see is that we completed initial 5 waves back in June, early June. And we're seeing a small bounce in wave B, and now we're in wave C sell-off. This wave C, if it reaches the 100% extension of this wave A, we can challenge the 20-day moving average. Google, in terms of valuation, is quite stretched versus its own history. And if you account for quite aggressive 20% plus growth rate, I would say that if you looking at the traditional valuation models, it's still it's still pretty much priced in. So it's priced to perfection at this moment. Everyone thinks Google is the best AI play. And when the position is that crowded, we can see a big pullback next. But overall, I do think this is more of a wave 4 pullback when it finishes. We will see one more high in wave 5 after the consolidation period. Meta, I just want to zoom out first. What we can see is that we are at a critical support line region where this support line has been tested 4 times previously, and today is the 5th time and he's managed to hold. So it's rising highs. So on the broader degree, the chart is still supportive, but if you look at this as the lens of the head and shoulders pattern, then this could be the left shoulder, this is the head, and this could be the right shoulder. If we break below the support line, which is the neckline, and then we can see a much lower low, and this whole bullish thesis is probably invalidated. But for now, we give Meta the benefit of the doubt that it could hold here. It's completing 5 waves of wave C in the sell-off, which is a 1-2 setup still. And if it does complete here, we can target wave 3 above 850. So this is contingent on basically Meta holding here and having a breakout above the 200-day moving average. Then we can start looking at the bullish trend. For now, near term is doing a bear trend. I would stay quite cautious. And of course, if you like the risk and reward, we could have maybe a stop around here, 520 level. That's the previous low in March for a rebound play towards wave 3. So Microsoft, very unfortunately, Microsoft broke below this with a low in March. So if you remember the IGV chart, IGV is actually holding above this low. And previously, I did think that maybe we can get a 1-2 setup here, looking for a higher high, and that could be the beginning of a new 5-wave upwards trend. But now, looking at this, we are opening the door to a lower low here in wave C. So this whole move was just wave B rebound that got rejected by the 200-day moving average, and we're looking at potential head and shoulders pattern from 2024. So this is the left shoulder, the head that was reached in August 2025. And over here, we're having the right shoulder, which is at the same level as the left shoulder. So it's quite symmetrical here. If we break below this neckline, we're looking at a wave C that could trade below 300. I think valuation-wise, 300 is pretty cheap, both in terms of its growth potential, even if it's in the mid-teens. NVIDIA is looking at a smaller degree pullback, that could be a wave 2 pullback. So if you look at the size of wave 1, we've retraced almost 60%. We're standing above the 200-day moving average and above this price channel. And that is basically the highs of this range here that started between September last year and ended around March this year. So while other semiconductors have doubled or even tripled, in the case of ARM, quadrupled, we are basically back to where we were before the war started. So I do think valuation-wise, NVIDIA does make sense. What I would like to see is maybe just for it to do a head fake down move and get some sort of support around this high volume region. We could test maybe around the 70% retrace of this wave 1. I think that's quite buyable zone. So you'll be basically paying at a better valuation than before because the business has grown, but the same price as you would pay in Q3 2025. And that does seem like a pretty good deal here. And of course, the risk is also better because if you force below this wave 2 low and you know this whole thing is invalidated, we can get out at a smaller loss. Tesla. So Tesla, this was a quite obvious three-wave move here for wave B, and I've been warning for a while that this could be a wave B top, and we start wave C down. And so right now, if we're in wave C, we're in 5-wave motion, and we have reached the 1.23 extension of this wave 1, and wave 3 typically ends around at least at the 138% extension. So there is a bit more room at 360 for the near-term target before a major bounce. And over here, I was quite neutral because I think the SpaceX IPO is a new shiny object for Elon and could suck away the liquidity for Tesla, which it has. And now Tesla is also falling with the broader market, with the rest of the mega caps. So I am still cautious here. If we can get this wave C filled to the bottom of this price channel here, around 300, I think that's a pretty decent opportunity to buy. And one thing I would say is with Tesla, it doesn't, its valuation doesn't rest on the current, the car production and sales. Is more about the robotaxi play. But because the valuation is high, you will get this sort of price pattern where it just meanders in massive price range for 3-4 years, and it doesn't make new highs for a long time. And that's kind of the price you have to pay if you want to buy something that has a shiny future vision, but is priced very aggressively. That is the opportunity cost. AMD, so AMD should have completed wave 4 here, and I'm looking at wave 5. And wave 5 can reach above 600. It's holding pretty well here. So I think there could be one more high in wave 5 around 600 to complete this wave 3 cycle. After that, we can probably see a much bigger drawdown that may challenge the 100-day moving average or 200-day moving average after completion. Broadcom. So Broadcom, I like the name. I think its growth is pretty fantastic. Just looking at this retrace though, the momentum on the upside, it is quite weak. So it got rejected by the 50-day. Now is holding around the 100-day. You could attempt the 200-day. So I think the prudent time to buy when the semis start to cool is probably around this high volume node here. I think it's very similar logic to NVIDIA. I think they're quite attractively valued, but if technicals can bring us home a really great risk reward setup, where if we invalidate our bullish thesis at its low, we don't risk that much loss versus a massive wave 3 target down the line. Micron. So Micron, it attempted to break this trend line here and managed to reclaim it after earnings. But still, you can see that we are marginally above the beginning of the week, and we're selling pre-market here. So this wave 5 run is quite stretched. It's always difficult to call the top, but over here, the volatility is rising. and I'm still cautious to chase. I wouldn't short the stock for the reasons I've mentioned before, but I think a fresh entry warrants a lot of caution here. ASML slowed a little bit. I'm looking for wave 4 pullback. So it's actually not that stretched as a wave 3 target. So it's reached the 1.618 extension, which is quite standard for wave 3. Could even reach 1.76 at 2,100. That's quite normal. It's quite hard to fade, but I think a better entry point is if we get wave 4 pullback. If we get pullback towards the 100-day moving average, that'll be quite nice entry to target wave 5. Intel broke above this bull flag and above this wave 3 high. So I think now we're moving towards this wave 5 at 150 target. Lam Research, this wave 5 is looking just about the target level. So this is at 100% extension of wave 1. If it moves above 420, it's probably starting to look a bit stretched. Applied Materials, this wave 5 is looking a bit stretched, so it's 1.618. Extension of this wave 1, so that's quite stretched level. I'm cautious chasing here. I'll be much more comfortable if we get wave 4 pullback. Texas Instrument, I think we're probably beginning wave 5 here, even though we're still consolidating. So if this is a wave 5, we can be looking at a target around 360. ARM holding, so ARM has more than tripled since the February low and quadrupled since the April 2025. But for now, I think we made a new high versus wave 3. We could be in wave 5 here, and that wave 5 target could be above 500. So there may still be some upside left here. Qualcomm, I'm a little bit split-minded on Qualcomm because its reported earnings is sort of after the open. So if you look at the near term, this could be a head and shoulders pattern with this supporting neckline here, which was the highs of Jan 2026 and October 2025. If we break below here, then this wave 5 is probably in danger, and we are looking at a corrective bounce. So for now, it holds. I'm just a bit cautious, but perhaps this is a good risk-reward play for wave 5 if we have a stop just below this neckline and get out if the structure fails. VRT is quite hard to call the tops, but this wave 5 is quite extended. So I am a bit cautious here. It's trading around the 50-day moving average. It's failed to make a new high. So if it starts to make a new low versus the June 10th, then that could be the beginning of a downtrend. EQIX, we're looking at wave 3 here. It's short of target still, so we can push towards 1,200. Of course, it's pushing against this top price top. Of course, now it's reached the top of the price channel, so it might take a little bit more consolidation before we get one more thrust upwards. CoreWeave, I think nothing really has changed from the previous weeks. We are seeing a potential ABC here. We're seeing, so if this is an uptrend, this still could be called a bull flag, but this is quite a well-defined range. If we break below this support line, then definitely this is a corrective bounce, and we're looking at the removal of this bullish path. NBIS, this wave 5 is right at the target compared to wave 1 extension at 100% extension of wave 1 is not considered stretch yet. So going above 350 would be stretched. It's in a pretty well-defined price channel. So I would respect that and not call the tops too early. IREN, so IREN has been a bit disappointing in the sense that there was an attempt to break out, but it failed. And now I'm looking at this potential danger, which is we could be looking at a head and shoulders pattern that, so left shoulder, head and right shoulder, And if we fall below here, we're looking at revisit to this lower price channel. So I'm quite cautious if this structure breaks. Hut 8. So this is wave 3, and it's reached the 1.76 extension of this wave 1. So it's reaching the upper end of the target. Of course, it could always stretch to 200%. But over here is quite hard to chase after it moved from where is it? So not $10 to $130. So that's a 13x in just about a year. CSCO, I'm concerned this is a long island. So we could get retrace after this in wave 4. In terms of the actual price level, wave 5 is slightly stretched in terms of the target, but it's not extremely overextended, for example, at 150. But still, if you look at this chart, this final wave looks like a blow-off top-ish move. So I'm a bit cautious here. NET, so it's basically been the same structure. It's finding it difficult to break above 180, so consolidating in ending diagonal here. I still think wave 5 can get to the 210 level. So I should actually label this in appropriate degree. So SanDisk, so this is the power of compounding, because over here, when it was around 1,300, I do think we could get wave 5 high to above 2,000. And from here to here, it doesn't actually even look that much on the chart, because the stock used to trade sub 100 only a couple of years ago. So now we're at the wave 5, comparing to wave 1. We are exceeding the 1.38 extension, so that is a stretched level. It's very difficult to call the tops again, but it would likely move in sync with Micron. Seagate, again, this wave 5 is now pushing into the stretched territory at the 1.23 extension of wave 1. So I'm cautious here, but again, very difficult to call the tops. Western Digital, wave 5 isn't stretched just yet. So WDC has been running slightly behind STX in terms of levels, but now it's still, we're at the wave 5 target. So I don't mind taking profit here. PNW, still, I think on the smaller degree hourly chart, this does look like a 5 wave up. So we could be expecting a retrace and then one more high in wave 5 next. This wave 4 was shallow though, only at the 23% retrace of wave 3. So it's hard to rule out a deeper low, but in terms of the smaller degree chart, in terms of hourly chart, which is always a little bit less reliable, you can see that we are seeing quite solid 5 waves up here. So if we get a retrace down to this level, 270, that could be a buyable dip for wave 5. Looking at CrowdStrike, CrowdStrike is not as bullish versus PNW on the smaller degree. So this was only a 3-wave bounce. That is quite likely a wave B, and we can get wave C down to 550. That's the 100% extension of wave A. I think that is probably a quite buyable region. If we get there, we can get support from the 100-day moving average, which has now crossed above the 200-day as well. Cloudflare is now moving. It's still looking quite corrective to me. I still think this is a wave 3-wave move in wave B, and we can get wave C down. But overall, in the near term, this is a small uptrend, so it's hard to fade right now. So I'm a bit cautious either way here, so I'm neutral. Fortinet, I think it's due a wave 4 pullback, but it's been pretty aggressive, and it's also pushing the upper price channel. So I'm not chaser here. I would definitely wait for pullback at least towards the 50-day moving average. Zscaler, it moves more with the software cohort. I'm just concerned that this was just a corrective bounce, and we can get wave C much lower towards towards the 70 region, which does sound pretty cheap, but the market is not just pricing deceleration in growth, but also sometimes in negative growth because of the impact of AI or industry consolidation. Oracle, I think this was a very definitive ABC wave B bounce, and we're looking at wave C potentially sub 100 level, and this would become a head and shoulders pattern with a neckline, just like many charts we've seen in hyperscalers. Palantir, apparently Michael Barrett has covered his short, which is nice, but we're looking at a breakdown of this support line, and we've seen potentially targeting the low 90s. Salesforce, so Salesforce made a new low in the past couple of weeks, which could tap the 130 region for a deeper sell-off. Intuit, very similar. We're looking at 5-wave down inside of wave 5, and looking at the extension, we're at the target area compared to wave 1, but there is definitely room to get down to 220 to 230. Adobe, very similar. We're looking at wave 5 waves inside wave 5, and wave 5 now is at 100% extension of wave 1, which is a natural kind of target zone, but it could stretch down to 180. ServiceNow, unfortunately broke below this support line, so this wave 4 is becoming a bit less convincing. It still kind of holds above the wave 2, but otherwise this is probably quite big wave B bounce, and we're looking at one more low in wave 5. Datadog, this is a wave 4 retrace. I think it could tap the 50-day moving average to finish inside 38% retrace of wave 3, and then we're looking at one more high in wave 5. And Snowflake, still quite hard to read. The risk is that we get a gap fill. But overall, I do think we should be trending higher once we find consolidation. So if we can fill the gap and get to 180, I think that's a pretty attractive zone to play for either a corrective bounce overall. So this could be a sub-wave ABC bounce, and we're looking at a target of 300. Or if this is an impulsive move, we're looking at a target of 460 for wave 3. So that's it for this week. Thank you for tuning in, and let's speak again next week.